Right now, the average 30-year U.S. mortgage sits at around 6.5%. That means every extra dollar you put toward your mortgage earns you a guaranteed 6.5% return. No brokerage account, no market risk, no fees. So why do so many people invest instead? And who is actually right? By the end of this video, you will know exactly how to run that maths for your own situation. Yesterday we broke down how central bank rate decisions ripple into your mortgage and savings rate. Today, 3 things that turn that context into a concrete decision. 1. What the guaranteed return of overpaying your mortgage actually means in real numbers. 2. How a 7% expected market return stacks up against a 6.5% guaranteed debt return across the UK, Canada, and the US. 3. The 3 factors that shift the answer one way or the other, so you can run your own numbers tonight. Let us start with the concept most people breeze past. When you overpay a mortgage, you are not just chipping away at a debt. You are earning a return. A guaranteed one. Here is why. If your mortgage charges 6.5% interest, every pound or dollar of principal you eliminate early stops generating that 6.5% charge. The outcome is mathematically identical to putting that money into an account paying 6.5% with zero risk of loss. And right now, you cannot get 6.5% risk-free anywhere else. A U.S. Treasury 10-year note is yielding around 4.5%. A savings account tops out near 5% before tax. The mortgage paydown beats both, and it is locked in. Let us put real numbers on this. Take a $300,000 mortgage at 6.5% with 25 years remaining. Standard repayments, no extras. Now add $500 a month in overpayments. Over the life of that loan, those overpayments save roughly $80,000 in interest charges and cut about 5 years off the term. That $80,000 is not a forecast. It is not dependent on markets. It is a contractual certainty the moment you make those payments. For UK viewers, the same logic applies to your residential mortgage, though the structure differs. A $300,000 mortgage is roughly equivalent to a £240,000 mortgage at current exchange rates. For Canadian viewers, roughly $410,000 Canadian dollars. Most people think of overpaying a mortgage as a boring, conservative move. The math says something different. At today's rates, it is one of the best risk-free returns available. That framing matters because the alternative, putting that $500 a month into a brokerage account, carries real uncertainty. The guaranteed return of debt elimination is the benchmark the market has to beat. And right now, the gap between them is narrow. For most of the 2010s, this was an easy call. U.S. mortgage rates sat between 2.5% and 3.5%. UK rates were under 2%. Canadian 5-year fixed rates were around 2 to 3%. Meanwhile, global equity markets were returning 8 to 10% annually. The gap was so wide that investing almost always won on paper, even after fees. Then rates moved. The Fed data tells the story clearly. U.S. 30-year fixed rates hit 7.2% in May 2024, the highest since 2002. UK 2-year fixed deals crossed 6% in mid-2023. Canadian 5-year fixed rates reached 5.5 to 6%. The gap between the guaranteed return and the expected market return compressed dramatically, and that is why this question is genuinely harder today. As of mid-2026, the U.S. 30-year rate has eased back to around 6.5%. That is still high enough that the gap between a guaranteed mortgage paydown return and a long-run 7 to 8% expected market return is under 1 percentage point before fees and tax. One bad year in the market, and the mortgage paydown wins retrospectively. One strong year, and investing wins. That is the zone we are now operating in, and it means the right answer depends heavily on the 3 factors we will cover in the final section. Now the other side. What does investing that $500 a month actually produce over 20 years? The long-run benchmark for the S&P 500 is roughly 10.5% nominal per year over 30 years, or 7 to 8% after inflation, according to data compiled by NYU Stern. For a globally diversified tracker fund, the MSCI ACWI index has returned roughly 8 to 9% annualized in GBP terms over the past 20 years. Those are historically strong numbers. But they come with a critical caveat. They are averages across decades that included 2008, 2020, and several other gut-punch years. They are not a promise. Here is the same $500 a month, over 20 years, in two paths. Path 1, overpaying a 6.5% mortgage. Path 2, investing in a low-cost global index tracker at 7% annualized. After 20 years, the mortgage overpayment path frees up a fully paid home and avoids roughly $80,000 in interest. The investing path, at 7%, produces approximately $261,000 in portfolio value from those contributions alone. At 8%, it reaches roughly $294,000. The difference between 7% and 6.5% over 20 years is real but smaller than most people expect, around $26,000 before fees and tax. That is the whole point. This is not a landslide. One more dimension. For UK viewers, that $500 a month invested inside a stocks and shares ISA, approximately £395, grows entirely free of capital gains and dividend tax. For Canadian viewers, the same logic applies inside a TFSA. For US viewers using a Roth IRA, qualified withdrawals in retirement are tax-free. In each case, the tax shelter improves the after-tax investing outcome. Meanwhile, the mortgage paydown already delivers its return tax-free, because you are simply avoiding a debt cost rather than earning taxable income. So tax treatment is closer to a tie than most people assume, until you factor in employer match, which we will cover next. This is the section where the investing side can pull ahead, and it comes down to one number. Employer match. If your employer matches your pension or 401k contributions, even at 50 cents on the dollar, that is an immediate 50% return on your contribution before the market moves a single point. No mortgage overpayment can compete with that. If you have access to an employer match and you are not taking the full amount, the maths here is unambiguous: fill the match first. Every time. Only then does the mortgage versus investing question become genuinely close. Beyond employer match, the picture is more nuanced. For UK viewers, there is no mortgage interest tax relief on residential properties for standard borrowers since 2020. The ISA shields your investment returns from tax, but it does not give you extra deduction on the mortgage side. For Canadian viewers, the TFSA and RRSP both improve the investing side. RRSP contributions give you a deduction in the year you contribute, which can effectively reduce the after-tax cost of investing further, especially in higher tax brackets. For US viewers, a traditional 401k or traditional IRA defers tax, which may or may not benefit you depending on your bracket now versus in retirement. So how do you actually decide? It comes down to three variables you control. Lever 1 is your mortgage rate. That is your guaranteed return floor. The higher it is, the harder the market has to work to beat it. Lever 2 is your expected investment return after fees and tax inside your specific account. Not the headline index return, the net return in your hands after the fund charges and the tax treatment of your wrapper. Lever 3 is your personal risk tolerance, sometimes called the sleep at night factor. This one is not irrational. A market that returns 7% on average can also return minus 30% in a bad year. If that possibility causes you to make poor decisions, like selling at the bottom, the theoretical advantage of investing evaporates. Here is the break-even table. At a mortgage rate below 4%, a long-run 7% market return wins comfortably over 20 years. The investing path produces meaningfully more wealth, and the risk premium you are accepting is well compensated. At rates between 4% and 5.5%, the answer depends on your tax wrapper and whether you have employer match. At rates above 6%, the guaranteed return is close enough to the expected market return that personal factors, your job security, your emotional relationship with debt, your tax bracket, become the deciding variables. Above 7%, on a risk-adjusted basis, the mortgage paydown is genuinely competitive with expected equity returns in most scenarios. Let us put this in a real scenario. Meet Alex, age 34, earning $72,000 a year. Alex has a $280,000 mortgage at 6.6%, workplace 401k with a 50% employer match up to 6% of salary, and $500 a month spare. The right order is clear. First, Alex contributes 6% of salary to the 401k to capture the full employer match. That is $4,320 a year with $2,160 instantly added by the employer. Second, Alex considers putting the remaining discretionary savings toward the mortgage or a Roth IRA, depending on current tax bracket and expected retirement bracket. The employer match is not even a close call. Everything after that is a genuine trade-off between a 6.6% guarantee and a 7% expectation. Here is what we covered. 1. Overpaying a mortgage at today's rates of 6 to 7% gives you a guaranteed, risk-free return that rivals long-run equity averages, before fees and tax. That is a materially different situation from the 2010s when rates were under 3%. 2. A global tracker has returned roughly 7 to 8% annualized in real terms over 20 years, but that is a historical average, not a promise, and the gap over current mortgage rates is narrow, less than 1 percentage point in many cases. 3. Tax wrappers like the ISA, TFSA, and Roth IRA tilt the balance toward investing, employer match tilts it further, and your own mortgage rate is the single most important number to look up before you decide anything. If this breakdown was useful, the next video looks at another money decision that trips up even financially aware people, so hit subscribe and I will see you then. A quick reminder, this is educational content only, not financial, tax, or legal advice. Speak to a licensed professional in your jurisdiction before making any decisions.